Welcome to Capital Allocation Lab. Subscribe and like to support more educational episodes. Today we are undertaking a deep dive into one of the most fundamentally important yet continually blurred distinctions in the world of finance, and that's the difference between investment and speculation. This isn't just about semantics. This distinction really lies at the core of sound financial practice. We're drawing from some truly foundational source material here to try and cut through the decades of confusion that have grown around these two critical terms.
That's absolutely right, and it's a necessary endeavor. Because while the distinction between investment and speculation is understood in a general, often intuitive way by nearly everyone,
Sure.
when we try to formulate it precisely, we run into what the source material aptly calls perplexing difficulties. And this wasn't merely an academic failure in the past. The widespread failure to properly distinguish between the two was, in large measure, responsible for the market excesses we saw in 1928 and 1929.
And the calamities that followed.
And the immense financial calamities that ensued worldwide. That confusion, that intellectual blurring of lines, it continues to plague the ideas and policies of would-be investors today.
And it leads to what? Misplaced confidence.
Misplaced confidence and unnecessary risk, absolutely.
The stakes are incredibly high then. So our mission today is clearly defined. We must examine critically the various common meanings of the word investment because, as we will see, it has been used indiscriminately across multiple contexts.
Right.
Then we need to critique the popular yet flawed distinctions that people commonly use to separate them. Ultimately, we have to endeavor to crystallize therefrom a single, sound, and definite conception of investment, one that demands protection for the principal and provides a real analytical foundation for any financial operation you undertake.
It boils down to intellectual honesty with yourself. It's about knowing exactly what you're doing, and more importantly, knowing definitively whether you are engaging in an investment operation or a speculative one. And if it's the latter, the goal is to ensure that your speculation is, at the very least, a justifiable and intelligent one, rather than just blind hope.
Okay, let's unpack this immediately, starting with the word investment itself. Our sources tell us that investment is, quite frankly, a word of many meanings.
It really is.
So before we can arrive at that strict, rigorous definition we're seeking, we have to recognize and discard the initial, indiscriminate uses of the term that confuse the conversation.
Yes.
The first common meaning is the descriptive or business context. This relates to simply putting or having money in a business venture, regardless of the venture's inherent quality or risk profile.
Right. Think of this broadly as just capital committed to an enterprise.
For example, a local entrepreneur invests $1,000 in opening a new grocery store. That's a descriptive statement.
It is.
Or, on a larger scale, financial historians might look at the aggregate return on investment in the steel industry, which, when counting both bonded debt and retained profits, averaged a meager 2.40% during the fraught period of 1929-1938.
The key point about this first sense is its moral and analytical neutrality.
It's purely descriptive.
Purely descriptive. It makes no distinctions between a prudent venture and a reckless one, and it pronounces no judgment on the quality of the business or the return. Crucially, this definition accepts rather than rejects the element of risk. When we talk about an ordinary business investment, it is explicitly understood to be made at the risk of the business.
So it's an indiscriminate use of the term.
Fundamentally, yes. A simple statement of fact about capital allocation.
And that broad, non-judgmental use in the business context, it bleeds right into the second common meaning, which the sources call the financial omnibus word.
Yes.
This applies the term in a similar, indiscriminate manner to the entire field of finance. In this sense, all securities are called investments.
We hear it all the time. Investment dealers or investment brokers, investment companies or trusts, and investment lists.
And here, again, there is no real distinction made.
None at all. Not between a genuinely sound, low-risk operation and other types of financial operations like high-risk speculation. It's just a convenient omnibus word.
Encompassing everything.
Everything, but often used with a heavy admixture of euphemism. There's clearly this persistent desire in the financial community to lend a certain respectability or a veneer of stability to financial dealings of a miscellaneous and often dubious character.
And that euphemism can stretch the limits of credibility to the breaking point. I think the sources provide a fantastic and almost comical example of this, this financial linguistic stretching.
Oh, this one's great.
In October 1939, the SEC listed, under the formal title of investment company, the offering of stock of an entity named the Adventure Company, Ltd.
The sheer absurdity of the nomenclature there is palpable, isn't it? It just perfectly illustrates the problem.
The Adventure Company, Ltd., promoted, of course, by the Discovery Company, Ltd.
You can't make this up.
It was one par value stock, yet it was being offered to the public at $10 per share.
And even with that speculative structure and that clearly adventurous name, it was still categorized officially as an investment company.
Wow.
That historical footnote really tells you how loose and utterly non-distinguishing the term investment can be when used in this financial omnibus context.
It strips the word of all practical analytical value. But alongside these two indiscriminate uses, we finally arrive at the third and most important connotation, the limited one, where investment is consciously opposed to speculation.
And this is the definition that matters most for the practical conduct of sound financial operations.
Right.
This opposition is generally taken for granted in the popular mind, and historically it's commonly been thought that investment, in this special, strict sense, is inherently good for everybody, at all times and under all conditions.
And speculation.
Speculation, on the other hand, is understood to be a conditional operation. It may be good or bad, depending entirely on the prevailing market conditions and, crucially, the person who undertakes it.
So that's why arriving at a rigorous, definitive line between the two concepts is so vital.
Exactly. We must isolate and crystallize that third meaning.
But even in the opposition, we encounter that analytical difficulty we mentioned. It's so easy to fall back on results rather than definitions.
It is, which is why we hear the frequently cited and frankly rather cynical definition, an investment is simply a successful speculation.
And a speculation is merely an unsuccessful investment.
Exactly. And while it's glib and perhaps humorous, that definition is intellectually useless for an investor trying to make a decision before the result is known.
It's all retroactive.
It's purely retroactive. It's based purely on profit or loss rather than on the analytical quality of the operation itself.
So we need to move decisively beyond results and define the operation based on its inherent characteristics and the analysis underpinning it. We can see how fundamentally confusing the situation is by looking at contrasting examples of operations using the same asset. For instance, United States government securities are, in every financial framework, considered the preeminent, safest investment medium, correct?
Generally, yes. They are the gold standard of safety.
Yet, operations of a definitely speculative nature may be carried on, even in U.S. government bonds.
For example, by specialists who buy large blocks in anticipation of a quick, short-term rise based on an immediate yield curve change or some announcement.
So the underlying asset is safe, but the operation itself.
The intention, the time frame, and the reliance on market fluctuation rather than safety of principle, it shifts it entirely from investment to speculation.
And we see the inverse happen constantly with high-risk assets.
All the time. Let's look at the common stock of Radio Corporation of America, or RCA, back in the early 1930s. Between 1931 and 1935, that stock had no history of dividend payments, negligible reported earnings, and virtually no tangible assets behind it relative to the price.
So by any established rational measure,
Purchasing that stock during that period must certainly be classed as a speculation, a bet on the distant, unproven future.
But here's where it gets really interesting and reveals the danger of blurred lines. In 1929, before the crash, RCA Common was not only purchased, but was widely regarded as an investment.
It was included in the portfolios of leading investment trusts, which were supposed to be institutions dedicated to prudent capital allocation.
So the label investment was applied purely based on what? Hype.
Hype, market momentum, and aggressive future expectation, completely detached from the underlying reality or any established, quantifiable standards of value.
And that intellectual failure, the inability or unwillingness to properly distinguish between the two terms, exemplified by mislabeling RCA stock in 1929.
That's what fueled the financial madness and subsequent market calamities. We must now turn our attention to dissecting and demolishing the 5 most common yet deeply flawed ways people try to draw this vital line.
So the sources present us with a helpful, although ultimately insufficient, table of 5 common distinctions that are often treated as definite and characteristic markers.
But we are warned up front.
Yes, that in numerous individual cases, these criteria fail to apply properly, leading investors astray. We need to tackle them one by one, giving each failure the critical scrutiny it deserves.
Okay.
Let's start with the first and perhaps the most traditional distinction. Investment is in bonds, while speculation is in stocks. Seems simple enough.
It is simple, and it corresponds to a very common historical idea. It even has the weight of at least one historical authority on investment who insisted that only fixed income instruments or bonds qualify as true investments.
Yeah.
But this view immediately runs counter to the well-known universal acceptance of high-grade preferred stocks as legitimate media of investment.
Right. Preferred stocks are technically shares, not debt.
Exactly, yet their inherent safety profile often matches that of a high-quality bond.
And we have to look at the downside of that definition as well. If we accept this framework, we automatically bestow the title investment on all bonds.
Which is most dangerous. Why? Because the bond form itself does not inherently possess the credentials of an investment.
Meaning a bad bond is still a bad bond.
A poorly secured bond, one issued by a financially shaky company or one resting on insufficient assets and earnings coverage, may not only be thoroughly speculative, but it can be the single most unattractive form of speculation as well.
That's a powerful statement. Why is a poorly secured bond worse than, say, a common stock speculation?
Because a true speculative common stock, while risky, offers the potential for virtually unlimited upside profit. A poorly secured bond, however,
Gives you all the risk with none of the reward.
Exactly. It gives you the overwhelming risk of principal loss, the speculative risk, without the potential upside. Your return is capped at the fixed interest rate, but your principal is highly vulnerable. You get the risk of common stock without the possibility of significant appreciation.
So that distinction fails on both sides.
Completely. It fails on the risk side by including terrible speculations, and it fails on the quality side by excluding highly safe preferred and common stocks.
So conversely, we cannot logically deny investment rating to a strongly entrenched common stock merely because it possesses profit possibilities.
You can't. Even the general market view recognizes this fact, since at all times certain, especially sound common stocks, have been rated as legitimate investment issues.
And their purchasers were regarded as investors, not speculators.
Yes, simply due to the company's financial strength and stability. The asset-type bond or stock is descriptive, but it is not determinant of the quality of the operation.
Okay, let's move to distinctions 2 and 3, which relate to the method of transaction and the intention of the buyer. Investment involves outright purchases versus speculation as purchases on margin.
And permanent holding versus a quick turn.
Starting with marginal versus outright purchase. It should be obvious that buying a stock outright, paying for it in full, does not automatically transform that transaction into an investment.
Not at all.
If you buy a lottery ticket outright, that doesn't make it an investment. In finance, in truth, the most speculative issues, think of the riskiest, low-priced penny mining stocks we still see today.
They must be purchased outright.
Why is that?
Simply because no reputable institution will lend money against them. Their risk is too high to collateralize.
And the inverse is equally true.
Absolutely. Consider the massive campaign during the First World War when the American public was urged to buy Liberty bonds, even with borrowed money.
Those were still called investments.
They were universally classed as investments. And rightly so, because the collateral itself, the U.S. government promise, was considered absolute. If strict logic were followed in financial operations, and we must acknowledge this is a very improbable hypothesis for the general market.
A very improbable hypothesis, yes.
The common practice would be logically reversed. The safer, high-quality investment issues would be considered more suitable for marginal purchase because they pose less collateral risk.
And the riskier, speculative commitments
Should be paid for in full so that the owner and not the lender bears the entire burden of loss. The outright purchase criterion is definitely too weak to distinguish the two.
Okay, now let's critique the distinction based on intention. Permanent versus temporary holding. The idea is that if you hold an asset for a long time, say a year or longer, it's an investment, and anything shorter is a quick-turn speculation.
This definition is often suggested merely by its sheer convenience in accounting or tax law, rather than its intellectual penetration into the nature of the operation.
And the inexactness is proven by 2 established practices.
Yes. First, short-term investment is a well-established and essential practice. Think of managing corporate cash flow using money market instruments or T-bills.
They're temporary, but they are absolutely investments.
No question.
And the second practice is perhaps more ruinous for the average person.
Long-term speculation. It's equally well established, usually as a rueful fact of loss recovery. That's when the purchaser holds on for years, hoping desperately to recover a loss.
Though they might have been speculating for a quick turn.
But the outcome forced them into being a long-term holder. It's also carried on intentionally, like speculating on a long-term corporate turnaround that might take half a decade to materialize.
So defining the transaction by how long you hold it, it just doesn't work.
You're defining the state of mind, not the quality of the commitment.
Which brings us to the final two distinctions, which are intertwined and significantly closer to the truth. Investment is for income versus speculation for profit.
And investment is in safe securities versus speculation in risky issues. These two distinctions, when joined together, undoubtedly come closer than the others to both a rational and a popular understanding of the subject. For many years prior to the rampant boom of 1928, the typical investor had been primarily interested, above all, in safety of principal
And the income.
and the continuance of an adequate, reliable income stream. Profit was secondary or unexpected.
But then the whole emphasis dramatically shifted, fueling the excesses of the late 20s. How did that change in motive manifest?
The pervasive doctrine that common stocks are the best long-term investments, the mantra of the burgeoning new era, resulted in a massive transfer of emphasis
People started looking away from current income.
and toward future income, and hence inevitably toward the future enhancement of principal value or profit. This philosophy, in its complete subordination of the current income element to the powerful desire for capital appreciation, is practically indistinguishable from speculation.
So this new era style of investing, often exemplified by the strategies of the rapidly formed investment trusts, was really just speculation wearing an investment hat.
Precisely. This so-called investment, when applied to high-price growth stocks, can be accurately defined only as speculation in the common stocks of strongly situated companies.
Because you were relying entirely on the future.
Entirely on the future continuing to justify the high price you paid, which is the definition of speculation.
From a philosophical standpoint, it would undoubtedly be a wholesome step for financial literacy if we could return to the accepted idea of income as the central motive in investment, reserving the primary aim toward profit or capital appreciation as the typical characteristic of speculation.
It would be, but even this distinction, income versus profit, has important historical exceptions we need to address if we are to crystallize our final, truly robust definition.
Okay.
To understand the complexity of the income question, we have to look closely at historical exceptions where current income was clearly not the leading interest, yet the operation was universally considered a bona fide investment. A prime example involves bank stocks in the pre-war days. Prior to the early 20th century, these issues were regarded as the exclusive province of the wealthy, stable investor. What is fascinating for our analysis is that these bank stocks consistently returned a substantially smaller dividend yield than was available from high-grade bonds.
So they were poor income producers.
Relative to the available alternatives, yes.
So if they weren't buying them for the current income yield, which was subpar, what was the primary motivation that qualified the purchase as an investment?
They were purchased based on the rock-solid expectation that the steady, conservative growth in the bank's retained earnings and surplus would ultimately result in special distributions, stock dividends, and, most importantly, a steady increase in the principal value over time.
This is about the earnings being retained, not paid out.
Exactly. It was the earnings accruing to the stockholders' credit and being retained by the conservative management, rather than those distributed immediately in dividends, which motivated the purchase.
But arguing that this makes the bank stock purchase speculative would be entirely paradoxical under the old rules, wouldn't it?
It would create an absurd conclusion. If we accepted the narrow rule that investment requires adequate current dividend income, we would have to contend that only the banks which paid out most of their earnings and dividends could be regarded as investments.
Which is backwards.
It's completely backwards.
Yeah.
Consequently, banks following a conservative, sound policy of building up their surplus for future stability would then have to be considered speculative. That conclusion is obviously contradictory to sound banking and investment practice.
It forces us to broaden the definition of return.
Precisely. Because of this fact, we must admit that an investment in a common stock might conceivably be founded entirely on its underlying earning power and asset accumulation without requiring immediate high-rate current dividend payments.
So the focus shifts from what is paid out now to what is built up and retained safely. This vital realization brings us back strongly to the final distinction, which is the most potent: safety versus risk. If we drop the immediate income requirement as the ultimate litmus test, safety of principle becomes paramount. But, as you warned earlier, we have to be meticulous about how we define safety.
We do. If safety is to be judged only by the ultimate result, That is, whether you made money or not. We are virtually begging the question.
Right, that gets us dangerously close to validating the cynic's definition.
Exactly. An investment as a successful speculation. The quality of the decision must be judged at the moment of commitment.
That means safety must be posited, analyzed, and assured in advance. But even here, we run into the massive subjective problem of human optimism. The racetrack gambler betting on a perceived sure thing is utterly convinced that his commitment is safe.
And that is exactly what happened during the run-up to the 1929 crash. The 1929 investor in high-priced common stocks also considered himself perfectly safe.
But his sense of security relied on what?
Entirely upon future, indefinite growth to justify the high figure he paid and more. The expectation of safety was based purely on purchaser psychology, market euphoria, and optimism, not on any concrete, measurable standard of valuation.
So the concept of safety is only truly useful if it is based on something more objective and tangible than the psychology of the purchaser.
Absolutely. The safety must be assured, or at least very strongly indicated, by the rigorous application of definite and well-established standards of value.
And this is the crucial separating difference.
It is. The difference between sound investment and hopeful speculation. Let's contrast those two historical figures again. The 1912 bank stock buyer versus the 1929 common stock buyer.
Okay.
The 1912 buyer purchased the stock at price levels which he considered conservative in the light of long experience. He was satisfied, based on his concrete knowledge of the institution's resources, stability, and established earning power, that he was getting his money's worth in full.
And
Crucially, if a strong speculative market resulted in advancing the price to a level that was obviously out of line with these established standards of value, he was disciplined enough to sell his shares.
that mindset is the missing link. He used the standards of value to define the maximum acceptable price, not just the minimum quality.
Had that same attitude, that discipline evaluation, been taken by the purchaser of common stocks in 1928-1929, the term investment would not have been the tragic misnomer that it was. But when the public proudly applied the designation of blue chips to the high-priced issues they favored, they unconsciously revealed that the primary motive at the heart of their supposed investment selections was, in fact, gambling on continued exponential growth.
The fundamental error was therefore intellectual.
It was. Failing to determine the worth of the asset by firmly established standards of value relative to the price paid, they outsourced their judgment to the collective crowd.
And that is the gravest error one can make.
It is. The market, swept up in its own fervor, essentially made up new standards as it went along by accepting the current price, however high, as the sole measure of value.
Leading to an illusory idea of safety.
Completely illusory and fraught with enormous danger. Carried to its logical extreme, this thinking meant embracing the dangerous idea that no price could possibly be too high for a good stock, and that such an issue was equally safe after it had advanced from 25 to 200.
And that, ultimately, destroyed the principle of countless individuals who sincerely believed they were investing safely, based only on the quality of the company, ignoring the price they paid for it.
Yes.
This critical comparison, the need for analysis and standards versus trusting optimism and current price, provides the necessary foundation for a proper, rigorous definition. Let's present the author's suggested definition, which successfully harmonizes popular understanding with analytical precision.
Let's hear it.
The suggested definition is this. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative.
That definition is incredibly clean and powerful, but as you said, the implications and the precise meaning of those three key terms, analysis, safety, and return, are absolutely vital to understanding why it works and why it remains timeless.
Right.
First, notice the subject. We speak of an investment operation rather than an issue or a purchase. This is crucial because it is profoundly unsound to think always of investment character as inherently belonging to an issue per se.
Because a price is an essential element.
It's an essential element. A stock and even a bond may possess undeniable investment merit at one price level, but entirely lose that merit at another.
So the analysis must always look at the price paid relative to the quality of the underlying asset, not just the quality of the asset in isolation.
That's the core mandate. It forces the investor to be disciplined about valuation.
And it also applies to groups of stocks.
That's right. Furthermore, an investment might be justified only if made in a diversified group of issues, which would not be sufficiently safe if made in any one of them singly.
So diversification itself can be a component of safety.
It might be necessary to reduce the inherent risk involved in the separate issues to the minimum consonant with the requirements of investment safety. This would be true, in general, of most purchases of common stocks for investment, where no single stock is perfectly safe.
Okay.
We also need to acknowledge that certain complex mechanisms, like specific types of arbitrage and hedging commitments, can qualify as investment operations.
How so?
Because the element of safety is provided by the structured combination of purchase and sale, even though this extends the ordinary concept of a simple buy and hold strategy.
Okay, let's nail down the phrasing and the definition. The phrases thorough analysis, promises safety, and satisfactory return are all chargeable with indefiniteness in everyday language, but their meaning here must be clear enough to prevent serious misunderstanding.
Right.
What exactly is a thorough analysis?
By thorough analysis, we mean, of course, the study of the current and historical facts in the light of established quantitative standards of safety and value.
So you're explicitly ruling out analysis based on hope.
We are explicitly ruling out any form of analysis that relies primarily on hope, momentum, or indefinite future prospects. This rules out, for instance, any analysis that recommended investment in General Electric common at a price 40 times its highest recorded historical earnings, merely because of its excellent, vague prospects.
That's not analysis.
That recommendation would be clearly ruled out as devoid of all quality of thoroughness. It's marketing, not analysis.
That means the bar for analysis is set high. What about promises safety? Does that imply absolute guaranteed certainty of principal preservation?
No, absolute or complete safety is a fantasy in any capitalist market. The word promises means, rather, protection against loss under all normal or reasonably likely conditions or variations the market might throw at you.
So a safe bond.
A safe bond, for example, is one which could suffer default only under truly exceptional and highly improbable circumstances, such as a complete systemic collapse.
And a safe stock.
Similarly, a safe stock is one which holds every prospect of being worth the price paid, except under entirely remote or unlikely contingencies, where study and experience indicate that an appreciable chance of loss must be recognized and allowed for. We have instantly entered a speculative situation.
It's the difference between protecting against a typical recession versus protecting against a meteor strike.
Precisely. You invest against the foreseeable risks.
And finally, satisfactory return. This is clearly broader than just demanding a high current dividend income.
Yes, it is a wider expression than adequate current income, since it allows for capital appreciation or profit, as well as current interest or dividend yield.
And satisfactory is subjective.
It is, by necessity, a subjective term. It covers any rate or amount of return, however high or low, which the investor is willing to accept, provided they act with reasonable intelligence and understand the full implications of the return they are receiving relative to the risk assumed.
This definition is robust because it places the burden of proof analysis, safety, and return squarely on the operator, not the asset itself. However, it still feels necessary to introduce the crucial additional criterion focusing squarely and unavoidably on price to drive home the lesson of the 1929 crisis.
This is so important.
The additional criterion is this. An investment operation is one that can be justified on both qualitative and quantitative grounds.
That quantitative element is the final, non-negotiable anchor. We must warn you, the listener, that prevailing financial opinion often resists this fundamental principle, especially in boom times.
Oh, absolutely.
But we are absolutely convinced that to regard investment quality as something independent of the price paid is a fundamental and dangerous error that guarantees future loss.
The price warning cannot be overstated.
It can't, particularly today. In the case of high-grade short-term bonds, price may not be a major risk factor. But in the common stock field, a serious and unavoidable risk of loss of principal may frequently be created by nothing other than an undue, excessive advance in price.
So even the best companies can be speculative guys.
This means that the vast majority of common stocks of even the strongest, most exemplary companies must, by this analytical standard, be considered speculative during most of the time, simply because their market price is too high to warrant safety of principal in any intelligent sense of the phrase.
You are paying a speculative premium for futures certainty.
Yes.
To bring home how fundamental and rigorous this price requirement is, let's use a highly specific historical example to show how the same underlying security can be either a speculation or an investment purely based on the price paid and the associated analysis.
Okay.
We're looking at two contrasting transactions involving General Electric Special, which was a preferred stock, occurring in successive months. Example 1. Speculation by overpaying. In December 1934, this issue sold at $12.34 per share. It paid 6% interest on a $10 par value, and here's the crucial fact. The stock was callable on any dividend date at $11 per share.
Okay.
Now, in spite of the preeminent quality of this issue regarding the safety of its dividends, the buyer who paid $12.34 was speculating to the extent of more than 10% of their principal.
That buyer was essentially gambling. They were wagering that the issue would not be called for redemption for a long period specifically, long enough for the stream of dividends to recoup the premium they paid above the $11 call price.
And they were ignoring a known, quantifiable ceiling.
Completely. A ceiling on their potential principal return.
And what happened in reality? That speculation failed immediately.
It did.
As it happened, the issue was called that very month for redemption at $11 per share on April 15, 1935.
Ouch.
The speculator who bought at $12.34 took an immediate loss of 134 points per share. They paid $12.75 for something they knew was guaranteed to be worth no more than $11 in the near future.
So the loss was entirely self-inflicted and predictable.
If they had performed a thorough analysis of the terms, yes.
Now let's look at the fascinating immediate shift in the status of that same asset. Example 2, investment by price.
Right.
After the issue was officially called for redemption, the market price promptly declined to $11.
Of course.
At that price, the certainty of the upcoming redemption created an unusual, highly profitable opportunity for a short-term investment operation, potentially even on margin.
So let's walk through this.
We can read the calculation slowly and precisely as it demonstrates a 40% annualized return built on certainty, not speculation. Brokers buying the shares at 11, say on January 15, 1935, without paying commission, could have borrowed $10 per share thereon at an interest rate of not more than 2% per annum. This operation would have netted a sure return at the phenomenal annual rate of 40% on the capital actually invested, as shown by the following calculation.
Right.
Cost of 1,000 shares at 11 net, $11,000.
Got it.
Redeemed April 15, 1935 at 11 plus dividend, point 150. Gross profit, $150.
Right.
Less 3 months interest at 2% on $10,000.
Net profit.
Net profit.
Which means?
Net profit of $100 on $1,000 in 3 months is equivalent to annual return of 40%.
Wait, so they were essentially engaging in a zero-risk arbitrage opportunity based purely on guaranteed dates and prices and achieving a 40% annual rate of return on the capital they actually had to invest.
That is the power of investment driven by price certainty. The safety and the resultant investment character of this unusual operation derives solely from the fact that the holder could count absolutely on the redemption of the shares in April 1935.
There was no speculative factor required.
None whatsoever.
This single example is vital because it proves why those first 4 common distinctions were flawed. This definition allows an operation to be defined as an investment, even though it was made in stocks, carried on margin, and purchased for a quick profit.
Provided the assurance of safety and the satisfactory return is absolutely based on adequate quantitative analysis of known facts. Having established our rigorous, price-sensitive definition, let's briefly look at the philosophical relationship between the future and these 2 core concepts. It may be said, with some approximation to the truth, that investment is grounded heavily on the past and present, whereas speculation looks primarily to the future.
That seems logical, but you noted it's an incomplete statement. Why?
Because both investment and speculation must inevitably meet the test of the future. They are both subject to its vicissitudes and are judged by its final verdict.
But the critical difference lies in their attitude toward the unknown.
Exactly. For the investment operation, the future is essentially something to be guarded against. You build in margins of safety to protect your principal from negative future surprises.
Any upside is a bonus.
If the future brings unexpected improvement, so much the better. But investment as such cannot be founded in any important degree upon the expectation of improvement.
And speculation.
Speculation, on the other hand, embraces that expectation. Speculation may always properly and often soundly derive its basis and its justification from prospective developments that fundamentally differ from past performance or present reality.
Like a technological breakthrough.
Betting on a technological breakthrough or a massive shift in consumer tastes is speculation, and it must rely on a future that looks different from the past.
Given the persistent confusion surrounding the terminology, we should review the 4 suggested types of investment usage to manage the different meanings that are unfortunately prevalent in the market today.
These are 4 categories of usage found in general discourse. The first is business investment,
which refers simply to money put or held in a business.
the broad descriptive sense we discussed initially. The second is financial investment or investment generally,
The omnibus term.
referring to securities generally, regardless of their quality or risk. The third is sheltered investment.
That's a useful term.
It is, referring to securities regarded as subject to small risk by reason of their strong prior claim on earnings or because they rest upon an adequate taxing power, like government bonds, or very high-grade corporate debt.
And finally, the fourth.
The analyst's investment. This refers specifically to operations that, upon thorough study, promise safety of principal and an adequate return.
And this last one is the distinct, rigorous sense we have developed here.
And the one that should guide your decision-making.
Now, we also need to maintain the crucial distinction of speculation from gambling.
Yes. Wall Street often takes the official position that gambling represents the creation of risks that did not previously exist, such as placing a bet on a horse race or a throw of the dice.
Whereas speculation.
Speculation, however, applies to the necessary taking of risks that are inherent and implicit in a situation, and so must be taken by someone in the financial structure.
Right. And within that broad category of speculation, the source material suggests a practical distinction between intelligent and unintelligent speculation.
And while a formal academic distinction is open to theoretical objections, it has enormous practical utility for you, the individual investor.
It does.
Absolutely. Intelligent speculation is defined as the taking of a risk that appears justified after a careful and disciplined weighing of the pros and cons.
The operator has done the work.
Understood the odds and accepted the risk knowingly.
And unintelligent speculation.
Conversely, unintelligent speculation is simply risk-taking without adequate study, without deep consideration of the situation, and often based purely on rumor, enthusiasm, or market tips.
We can draw parallels in business. Most well-considered but risky enterprises fall into the intelligent speculation category.
But many ill-conceived, hastily organized businesses must be called unintelligent speculations.
Similarly, a great deal of common stock buying in finance is intelligent speculation, where the buyer understands the risk premium they are paying.
But a vast amount is done upon inadequate consideration, relying solely on hope, and is thus unintelligent speculation.
Only the exceptional case.
Only the exceptional case, where a common stock is bought on such attractive terms, qualitatively and quantitatively, as to set the inherent risk at an absolute minimum, qualifies as an analyst's investment.
That leads us nicely to the concept of investment and speculative components, which is crucial for modern high-growth markets.
Yes. If a proposed purchase cannot qualify as an analyst's investment at a certain price, it is by definition speculative. But it may be analytically useful to view the purchase price itself as being split between its underlying value and its hope premium.
How does an analyst perform that split?
The analyst can divide the price paid into a measurable investment component and an estimated speculative component. Let's take the historical example of General Electric Common at its average price of $38 in 1939.
Okay.
The analyst might conclude, based on historical earnings, assets, and guaranteed stability, that up to, say, $25 per share is justified from the strict standpoint of investment value, the price at which they promise safety of principal.
And the rest of the price.
The remaining $13 per share represents the market's average appraisal of the company's excellent long-term prospects, including, perhaps, a rather strong psychological bias in favor of this outstanding enterprise.
So on the basis of that study, the price of $38 for General Electric included an investment component of some $25 per share and a recognized speculative component of about $13 per share.
Exactly. If this analysis is sound, it follows that at a price of $25 or less, General Electric Common would constitute a complete analyst's investment, meaning you're paying only for the underlying guaranteed value.
But above that price.
Above that price, the buyer must clearly recognize that they are paying a premium for the company's very real speculative possibilities, and that $13 premium is at risk.
This framework helps us clarify the difference between investment value, speculative value, and intrinsic value. Intrinsic value was defined previously as the value justified by the facts.
It's important to recognize that intrinsic value is by no means limited only to value for investment, i.e. to the investment component of total value, but may properly include a substantial component of speculative value.
Provided that it's arrived at rationally.
Provided that such speculative value is intelligently and rationally arrived at.
So the market price only exceeds intrinsic value when
the market price is clearly the reflection of unintelligent speculation, when the price is based on emotional exuberance or irrational fantasy that the facts simply do not justify.
And generally speaking, it is the function of the stock market, and not solely the analyst, to appraise those difficult-to-quantify speculative factors in a given common stock picture.
Yes. To this important extent, the market, not the analyst, determines the full intrinsic value. The range of such an intelligent appraisal, however, may be very wide, showing how difficult price discovery can be.
So, for example,
We can see that with the example of J.I. Case Common in 1933. The intrinsic value acceptance range was suggested to be as high as $130 or as low as $30, based on different but still intelligent interpretations of the underlying facts.
that's a huge range.
It is, and at any point between these broad limits, it would have been necessary to accept the market's verdict, changeable as it was from day to day, as representing the best available determination of the intrinsic value of that volatile issue.
Ultimately, the role of the analyst and the prudent investor is not necessarily to beat the market's appraisal of the speculative component, but to establish the standards and determine the minimum investment component, ensuring that the operation promises safety of principal and a satisfactory return.
And if the price goes above that minimum, the risk element, however intelligent, must be acknowledged and accounted for.
So we circle back to the fundamental principle.
That investment quality is not independent of price. That must be the foundational thought you carry with you after this deep dive. If you take away anything today, remember that the price you pay determines the risk you accept. Thanks for joining us. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.